Are you making these financial mistakes in your 20s and 30s? That's a question we should all be asking ourselves. Why? Well, your 20s and 30s are the time when you lay the foundation for your financial future. It's when you start earning, spending, saving, and hopefully, investing. But it's also when a lot of us make some common financial mistakes that can have long-lasting impacts. Navigating the financial world can seem complicated, but it doesn't have to be. It's all about understanding the fundamentals and avoiding certain pitfalls. You see, the decisions you make during these crucial years can either set you up for a life of financial stability or a future filled with monetary woes. So, let's talk about it. We're going to cover the top 10 financial mistakes people often make in their 20s and 30s and provide some advice on how to sidestep them. Let's dive into the top 10 financial mistakes you need to avoid. Starting at number 10, we have not saving for retirement. You might think, hey, retirement is ages away, I've got plenty of time. But the truth is, the earlier you start, the better. Why? 2 words: compound interest. Think of it as interest on interest. Over time, compound interest can turn your modest savings into a substantial nest egg. Here's a quick example. If you start saving $100 a month at age 25, with an average annual return of 6%, you'll have accumulated over $400,000 by the time you retire at 65. But if you wait until you're 35 to start saving the same amount, you'll end up with less than half that amount. So, it's not just about the amount you save, but when you start saving. The power of time and compounding can work wonders for your retirement savings. Remember, it's never too early to start saving for retirement. At number 9, we have living beyond your means. This is the financial equivalent of skating on thin ice. It's all fun and games until the ice cracks. When you spend more than you earn, you're not just emptying your wallet, but also potentially racking up debt that can spiral out of control. Imagine it like this. You're digging a hole that gets deeper every time you overspend. The deeper the hole gets, the harder it is to climb out. And the interest? That's like someone throwing dirt back in the hole while you're trying to climb out. But don't fret, there's a simple solution to this. Budgeting. By keeping track of your income and expenses, you can ensure you're not spending more than you're earning. Consider using budgeting apps or old-fashioned spreadsheets, whatever works best for you. Remember, budgeting isn't about depriving yourself, but rather making sure your spending aligns with your income. By living within your means, you can avoid unnecessary debt. Coming in at number 8 is not having an emergency fund. Picture this. What if your car breaks down, or you find yourself suddenly out of work, or a health issue pops up? Life is unpredictable, and these unexpected expenses can throw a wrench into your financial stability if you're not prepared. That's where an emergency fund comes into play. It's like a safety net for your finances. An emergency fund typically holds 3 to 6 months worth of living expenses. It's not about being pessimistic, but rather being practical. When you have an emergency fund, you have the ability to deal with these financial surprises without having to resort to credit cards or loans, which can further compound your financial woes with interest. Building an emergency fund might seem daunting, but starting small and gradually increasing your savings can lead to substantial growth over time. Remember, every little bit counts. An emergency fund gives you financial security and peace of mind. At number 7, we have ignoring insurance. Now, insurance might not seem like the most exciting topic, but it's a crucial part of a sound financial plan. Whether it's health, life, or even auto insurance, having an adequate coverage can provide a safety net against unexpected financial loss. Think of it as a parachute. You hope you'll never need it, but if you do, you'll be glad it's there. Too often, people in their 20s and 30s underestimate the importance of insurance. They feel invincible, assuming that they'll always be healthy and accidents won't happen to them. But life is unpredictable, and it's essential to be prepared. Insurance can help protect your finances from major setbacks that could otherwise derail your financial journey. It might seem like an unnecessary expense now, but it's a small price to pay for peace of mind. Remember, insurance isn't about expecting the worst, but being prepared for it. Insurance is a safety net you can't afford to ignore. At number 6, we have not investing. When you're young, you might think investing is something that only older, wealthier people do. But in reality, investing is something everyone should be doing, regardless of age or income level. One of the most significant benefits of investing is the potential for passive income. This is income that you earn without having to actively work for it. Imagine a river of money that keeps flowing into your bank account, whether you're working, sleeping, or on vacation. That's the power of investing. Plus, thanks to compound interest, the earlier you start investing, the more your money can grow. It's like planting a seed and watching it grow into a mighty tree. So don't wait. Start investing today, even if it's just a small amount. Remember, it's not about timing the market, but time in the market. Investing is one of the best ways to grow your wealth. At number 5, we have neglecting your credit score. Now, you might think, what's in a number? But let me tell you, it's a lot more than you can imagine. A credit score is like your financial report card. It's a measure of how trustworthy you are when it comes to managing your money, and it plays a vital role in your financial life. Lenders, landlords, and even some employers check your credit score to determine your financial reliability. A low score can lead to higher interest rates on loans, difficulty in securing housing, and could even affect your job prospects. Maintaining a good credit score isn't rocket science. Pay your bills on time, don't max out your credit cards, and keep your debts in check. It's about responsible money management. Remember, your credit score isn't just a number. It's a reflection of your financial health. A good credit score opens doors to financial opportunities. Coming in at number 4 is avoiding financial education. Now, we've all heard the saying, knowledge is power, and this couldn't be more true when it comes to managing your finances. Navigating the financial world can be a daunting task, but it doesn't have to be. The more you know, the better decisions you can make, and the less likely you are to fall into common financial traps. Financial literacy is not just about knowing what a savings account is or how credit cards work. It's about understanding the ins and outs of financial planning, investments, taxes, retirement funds, and so much more. It's about being able to make informed decisions that will benefit you in the long run. So don't shy away from seeking financial knowledge. Read books, attend workshops, listen to podcasts, or even hire a financial advisor. Remember, the key to financial success is continuous learning. Knowledge is power when it comes to managing your finances. At number 3, we have not setting financial goals. This is a common mistake that can lead to financial instability. It's like setting off on a trip without a map. You might end up somewhere unexpected, and not in a good way. Setting clear and achievable financial goals is crucial. They can range from short-term goals like saving for a vacation, to long-term goals such as buying a house or planning for retirement. These goals can provide a roadmap for your financial journey, helping you make informed decisions about spending, saving, and investing. Without set goals, it's easy to lose track of your money. You might find yourself spending on unnecessary things, or failing to save enough for important future needs. Remember, your goals should be SMART, specific, measurable, achievable, relevant, and time-bound. This way you can track your progress and make adjustments as needed. Goals give direction to your financial journey, so start setting yours today, and take the first step towards financial stability and freedom. At number 2, we have relying on one income stream. Now imagine this, you're in a boat with a single oar. It's functional, it's getting you where you need to go. But what happens if that oar breaks? You're stuck, right? That's what it's like relying on a single income stream. It may seem sufficient for now, but it's a risky game to play. You're placing all your eggs in one basket, and if that basket were to break, you could find yourself in financial hot water. The solution? Diversify your income. Consider exploring passive income opportunities like real estate investments or dividend-paying stocks. Maybe you've got a knack for something that could be a side hustle. The goal is to create multiple streams of income, so if one stream dries up, you've got others to fall back on. Remember, financial security isn't just about how much you earn, but also how you earn it. Multiple income streams provide financial stability. And finally, at number 1, we have not planning for the future. It's easy to get caught in the moment, focusing on the here and now, but the future is just as important, if not more so. It's like trying to navigate a ship without a compass. You might drift aimlessly and end up somewhere you don't want to be. Long-term financial planning is a critical part of achieving financial success. It involves considering future needs, such as buying a house, starting a family, or even retiring comfortably. You need to think about where you want to be in 5, 10, or even 20 years from now and plan accordingly. Consider your future needs and goals and create a financial plan that aligns with them. And remember, it's never too early or too late to start. The sooner you begin, the better prepared you'll be for whatever life throws your way. Planning for the future is the key to financial success. So there you have it, the top 10 financial mistakes to avoid in your 20s and 30s. Let's take a quick journey back through them, shall we? Starting off with not saving for retirement. It's never too early to begin, and the earlier you start, the more time your money has to grow. Don't delay, start today. Then there's the trap of living beyond your means. Always remember, it's not about how much you earn, but how much you save. So, make a budget, stick to it, and live within your means. We also talked about the importance of having an emergency fund. Life is unpredictable, and having a safety net can save you from financial distress. Aim to build a fund that can cover at least 3 to 6 months' worth of living expenses. Ignoring insurance is another common mistake. While it may seem like an unnecessary expense now, insurance can save you from financial ruin in the face of unexpected events. So, get insured. Next, we discuss the benefits of investing. It's a powerful way to grow your wealth over time. So, educate yourself about the different investment options and start investing. Neglecting your credit score is a no-go. A good credit score can open doors to better financial opportunities. So, pay your bills on time, keep your credit utilization low, and monitor your credit report regularly. Avoiding financial education is a pitfall too. Knowledge is power, especially when it comes to finances. So, invest in learning about money management. It will pay off. We also emphasize the importance of setting financial goals. Having clear, measurable goals can guide your financial decisions and keep you motivated. So, set some goals and work towards them. Relying on a single income stream can be risky. Diversifying your income can provide financial stability and open up more opportunities. So, explore different ways to earn money. Lastly, we talked about the importance of planning for the future. Your financial decisions today will shape your tomorrow. So, plan wisely. By avoiding these financial mistakes, you can pave the way for financial success and security in your future. Thanks for watching, and don't forget to subscribe for more financial advice.